Is the U.S. economy headed for a soft landing, or are investors too complacent about inflation and the Fed's determination to rein it in? Hi, everyone. Welcome to the Daily Briefing. Harry Melandri, advisor at MI2, is here with us today to help us sort through the inflation data and the market's kind of choppy reaction to it. Hi, Harry.
Hi, Maggie. Great to see you again.
Yeah, it's good to see you. So, we had a PPI number that came in today, a little bit lower than expected, really kind of mirroring what we saw with the CPI number. We also had the less talked about US jobless claims. They were rising again. What are you thinking about the US economy right now?
It's a broad question, um, but so on the economy's slowing. It's definitely there's little doubt about that. Whether it's slowing at the pace that would reduce inflation and get the Fed off the market's back is a different matter. I don't really think I don't believe in the happy ever after happy ending here. I just can't see how the slowdown is going to be sufficiently deep without additional delivered hikes to satisfy the Fed.
Yeah,
So
because what seemed to happen, and I don't know if tell me if this is what it looked like to you, but and it can be confusing because we seem to have a situation when we saw the easing, and by the way, the sort of year-over-year numbers are still very high, but it's decelerating. Everyone thought, "Oh, okay, inflation's going down. We're gonna have a recession, but it's gonna all happen in a condensed enough fashion that the Fed's gonna be able to pivot, and that recession will look something like a soft landing." Like the kind of perfect track. And we know the Fed has a terrible track record on that, but that seemed to be what the sense was coming through yesterday. Today, it looks like people are rethinking that a little bit, but you know, what do we, what is it that you think people are grappling over? Where is the disagreement? Why do we see this sort of knee jerk reaction and everything?
so I think the first observation I'd make is that the best money managers in the world are probably mostly at the beach right here, right now. So a large amount of the decision-making capacity of this market is choosing not to make a decision.
Mm,
And that's kind of August markets are always thin. August markets are always choppy. I'm glad it hasn't been even thinner, even choppier, because they can get really nasty. So that's one observation. A second observation is that uh, the pain trade for this market, and particularly the professionals, is higher. The long short equity guys, I think they did a great job navigating the fall, the decline in stocks. Not so great at getting any exposure to this kind of rally. And I'm just watching the Wall Street bets guys. Like I don't really follow that as often as I should. Those guys are really sharp, right? Do not think of these people as retail. That ain't retail. That's sharp money and with a big retail following. They found some shorts I had on in my personal account, and luckily, these are not huge trades, so they didn't tear my legs off or anything. But I had Bed Bath and Beyond. I was short that. Um, I personally think it's a dead company, but maybe I haven't been in recently. It's just an opinion. That thing ran up 40% or something. August market, big short base. Great idea, guys. I'm with you. I see why you went for it. The pain trade, I think, for the hedge fund managers and for a good block of real money is higher. They don't have their full allocation.
wow, that's really interesting. It's funny that you brought up that because we have been, and it's been puzzling. We've been getting questions from viewers on that. What do you make of the fact that people are in these meme stocks again? I think people are looking at it as some kind of sentiment indicator, or is it some kind of risk on indicator? From what you're saying, it's just some people, really savvy people, taking a look at where there is, an imbalance or an opportunity. Tommy Thornton tweeted out something to that effect today and said, but I sort of think on the opposite side of this, if you miss the downside short trade with all the garbage stocks in the last year, the good news is you're going to get a second chance. Like
That's
people are
right.
just, yeah, people are just looking at this like, I can't believe it, scratching their heads in this, what is a really difficult environment, as you just described, that we have this kind of meme thing going. It was easier to understand when it was a raging bull market and everything was going up. What are you what are you thinking about this? I mean, is this going to sort of lure a lot of people in for some pain again or
You know, if you have them by a particular part of their bodies, their hearts and minds will eventually follow. So, yeah, it could force people out of trades. Um, it's, I think, me personally, I don't buy it. I was chatting just now. I do a podcast too, um, and I was just chatting to a technician, a guy called Axel Kibar. He's a fantastic technician, and I hadn't realised that we're near pivots in a whole bunch of interesting places. So look, I can always be wrong. My mother, if she was still around, would tell you, "Oh yeah, he can definitely be wrong." So don't be at all surprised about this. Me personally, I'm bearish. I'm bearish risk. I'm bearish risk because I have a whole bunch of Fed watching friends from other jobs I've done in the past. My
Mm,
Fed watching contacts are telling me Fed means business. Rates are going to three, 3.5, probably 3.5. The market's just about right in where they think rates are going. But if inflation doesn't come down in a timely fashion, the Fed will do more because Fed officials don't want to be embarrassed. Nobody wants to be the new Arthur Burns. Sorry, Mrs. Burns and other Burns relatives. So with that in mind, if we have inflation above where the Fed wants it, we can get more hikes than are currently priced.
mm,
Um, and what I'm also being told is the notion that we should cut rates. They will cut rates soon afterwards, and we've got like 60 basis points nearly of cuts priced into 2023 after we peak in March. People, when I talk to people about it, they resist that notion. The
mhm,
idea isn't that the Fed's going to keep jacking up rates forever, but the Fed will do something akin to putting them where they think roughly they should be, like they
mm,
think neutral at 3.5, maybe a little higher than that, and then leave them there to
hmm.
squeeze out some of the spec and to soften up this economy. And you know, labor markets are tight. I see it around me. I don't know if you see it as well.
Oh, absolutely, absolutely. But, this is where so just pause for 1 second. The podcast Harry does is The Next Big Trade because I know people are gonna try to find it so that because the idea that we're at a pivot point on many things is super interesting, so I myself wanna hear what Axel had to say, so it's The Next Big Trade. You can find it wherever you find your podcast. And, Harry started out working at the Bank of England, so and that's just the beginning of his, long career, so when he says he, has a lot of people who follow central banks, he's not kidding. Do you think on the labor market point though, I know that you moderate with macro insiders with Raul and Julian, and they're always saying, and Raul's always saying, labor market's a lagging indicator.
It is a lagging indicator, but you know, I would argue that despite the fact that it's a lagging indicator, it's embarrassing for
Yeah.
central bankers here and now to have 8% inflation, 8.5% inflation,
Mhm.
and to have a labor market super tight with rates here. Um, so they need to raise rates. They need to tighten financial conditions. And you know, equity markets rallying doesn't do anything to tighten financial conditions.
Right.
Financial conditions are way too loose relative to the real economy's performance and inflation. This doesn't compute, if you will. It's
Yeah.
not consistent.
And every time the stock market rallies, that happens. They're kind of working against what the Fed is trying to do. Harry, I haven't it's really interesting. I haven't we everyone's been so fixated on rates. Will they hike 75, 50? How long will they continue hiking? What's happening with quantitative tightening? I mean, no one's been talking about that. Is that contributing to tighter financial conditions? Is that a lever they have to operate in this environment?
So incrementally, it will be. It's only just starting,
Mm,
right? It's only just starting, and I've forgotten the run rate for QT. For some reason, something like 90 billion a month rings a bell. You
yeah.
know, and after a while, 90 billion here, 90 billion there, eventually adds up to real money. Um, I think I'm very concerned about risk markets despite the rally. And as I said, technically we could pivot. I could reach stops and decide, you know what, you don't know what's going on, get out. But because that's QT is happening simultaneously with much higher rates and simultaneously with issues surrounding bank ratios, bank risk ratios like SLRs. So my understanding is banks will have to lighten up by about 90 billion risk-weighted assets by year end, or is it maybe
Mm.
by March of 2023? None of this is particularly bullish. Now, my one caveat is when I'm looking at signs of stress, I see stress in the real estate market, and I don't think that's difficult to spot. I think a lot of guys are probably better briefed than me on what's going on in real estate. I see stresses in the private equity market. Some of that pressure will have come off, but most of all, I see stresses in the emerging markets. I see stresses outside of the US.
Yeah,
Um,
this is something that we've talked about a lot, and for our regular viewers and members, you'll hear people all the time talk about the dollar wrecking ball, right? The U.S. but dollar's been so
right,
strong, you're starting to see strains in emerging markets. I spoke with Mark Mobius, a longtime emerging market investor, and he, I think, sort of painted the dilemma that people find themselves in when they're trying to figure out directionally what's happening with equity markets, with markets, and including those in emerging markets. Let's have a listen to what he said, and then we'll talk on the other side.
sure.
Well, you must remember that we're now really in a bear market. The market, as you know, hit 30% down, depending on what index you're looking at. So usually in such cases, there are opportunities. There's no question. It's a good opportunity to be looking at stocks that may be selling at very low prices. So yeah, I would say it would be a good idea to start nibbling. Let's put it that way. But I also feel that there's a chance for the other shoe to drop, so to speak,
Mhm.
because the Fed will definitely have to raise rates more and more. You know, the playbook is that the interest rates have to go higher than inflation. So with inflation now at about 9%, that's where interest rates have to go. So in that case, a lot of companies will be hurting. The housing market will be hit. So all of these factors are still in play, but the market has, in some ways, has anticipated that kind of movement. So I would say it's a good idea to be nibbling, but not put everything in.
Now, it's probably important to point out because we just got a little snippet there. The full interview is available on the platform, and I think you need to really watch the whole thing to get context because Mobius is a long-term investor. His time horizon is long, so when he's talking about starting to nibble, he's looking years out, and he has a bottoms-up approach, which is interesting, and I didn't really know that about him. And so those factors matter when he's talking about, yeah, you can start nibbling, but I think, and then he goes on to describe what is pretty horrible in the short term. So I think that's important to keep in mind. He's very concerned about Taiwan, some fascinating comments about Taiwan and China, and also about crypto. There's a wild debate raging on the exchange right now. Feel free to chime in or on Twitter because he loves digital assets, but does not have positive things to say about Bitcoin and Ethereum. So go check that out. But Harry, so he kind of presented the both sides of the coin there. What are you watching in emerging markets that has you concerned?
My positions. So, I'm up to I've got a load of RG restructured sovereign debt. Enough for my wife to ask me about it occasionally. Um, and that stuff has been crushed, absolutely crushed. I think it's cheap personally, but I make mistakes. Um, and this may well be one of them. But if you look around all over like Nigerian sovereign debt. I know that we were talking off-piste when we talk about Nigerian
Mm.
government bonds, but Nigerian dollar debt, that was trading at 14% too. Nigeria's got a 20% debt to GDP ratio. That's stupid. So why? And apparently they have oil. Rumor has it. So I don't. You can see that there's a lot of stress on the balance sheet of EM investors. They are not carrying the paper happily. And I think that's because a lot of people who would be naturally carry this paper are struggling to get hold of dollars. I have friends who talk to Asian investors, bigger Asian investors, and they have been reporting significant stresses in obtaining dollar financing for non-US entities.
Mm.
Significant people paying way above what you might think of as the right price for dollar financing to carry them through. And some of this might reflect if you were to say to me, guess what's causing that, I'd say that West Coast, maybe Asian entities who have clients on the West Coast of the US are struggling a bit to 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 fulfill orders or receive payments. Maybe their clients have stopped buying as much
Mm.
because of the private equity slowdown, and some of those clients at the margin, some of our tech giants are hiring a little less, spending a little less, so forth and so on. So maybe it's to do with that. But generally speaking, the dollar rallying and dollar rates going up makes it hard to get hold of dollar financing if you're offshore.
Yeah. I think you talked to Jeff Snyder, didn't you, for your podcast as well? And
Yeah.
he's always focused on collateral scarcity and, the concerns in the system. It can be hard to get your head around, but, worth taking a dive in, and super interested in that conversation. I want to get a couple questions in because we have them coming in. And G Media, I think that you're asking a question that is kind of how we started, which is, hi Maggie, could you ask Harry what are the chances of a range bound market here with S&P 500 at a 38 to 4200 range and oil 90 to 110 for some months and inflation still high but getting less bad slowly? It's kind of that soft landing. I don't think we want to call it Goldilocks, but it's kind of that, like, that scenario everyone's hoping for, but it seems like there's a pretty narrow path for that, Harry.
I don't know why they'd be hoping for it. It doesn't make any sense to me. If you have stocks and you don't like the idea they might go down, sell them. If you don't have them, don't you want them to go down? So, but is it
True.
possible? Yeah, it really is possible. It's not my core scenario because I don't believe in soft landings. I'm an old man. You can kind of tell by looking at me. I haven't seen many soft landings. I really haven't.
Right.
And for us to get a soft landing, one of the things you have to assume is that inflation is going to cooperate and go straight back in its box. Well, observation number one about stocks is that with 10% inflation, stocks got 10% cheaper in real terms. So you got a 10%. At one point, we were down to maybe 25, 30%. So all in, you were down 30, 35, 40%. That's not a bad discount. And I can see why the market might repudiate that level and come back up. Even here, they will trade, with a 10% discount because of inflation, and they are real assets. So most of these companies have something, has a factory or something which should retain value. They even have debt against it, which means they'll benefit from the inflation in some case. The debt is fixed rate. So that's one observation about why we might just chop wood at these levels. It's definitely not my core scenario because I'd say there's probably more spec in this market than meets the eye. And generally that has to get squeezed out. And
More speculation. Who do you think
yeah,
is it retail? Is it because people had been thinking that professionals are out of the market, equity market, but retail has hung in there. High net worth individuals have hung in there.
right. So that's definitely true, particularly high net worth. And I think high net worth may have been funding some of those, may have a levered book. I have this sneaking suspicion from some of the anecdotes I've heard that if you're an average American high net worth individual, like me, actually I'm not that high net worth, but never mind. I could be higher. Now.
You can find
So
out about that in the podcast we talked
yeah,
about. We talked
that's
about
right.
some of Harry's best and worst trades in my
That's
life
right.
before trades. It's fascinating.
But I've certainly both seen and heard and talked to other people who've suggested these trades to me, where you take your equity book and use it to finance real estate purchases.
Mm.
People have done that. People have encouraged me, and I have done some of these trades, to go into private equity in the last 3 to 4 years. Not all of those trades look so smart right now. I've done it. I don't see why other people wouldn't. And I was resistant to it because it felt late cycle already. Like, you don't want to do private equity late cycle. So I would guess that if I've done it, other people have done it. It's an easy thing to do. It made sense. People could give you a great story as to why you should do it. If you do private equity, you're getting in at levels, at multiples which are better than the public market. Not as better as they should have been, not as cheaper as they should have been, but a better level. There was a great story for it. It's not difficult to think that maybe there's a bunch of high net worth individuals who are a little bit over their skis. And I definitely have seen anecdotes about Rolexes coming out. Secondhand Rolex prices have been dropping. Secondhand, watches have been coming down.
Mm,
light airplanes, small boats. These are coming out. There are all sorts of good reasons why. I wonder.
I
So
like it.
that's our
Harry's
observation.
indicators, Harry's spec indicators.
Well, we try, right? You try to see what's going on, but whether that's successful is another matter.
So Sean from YouTube has a great question. How does Harry think about long bonds for a recession trade? Is it better to own long bonds or short the Nasdaq?
Some of this will depend on your tactical approach to trading, right? So if you are, it's hard to get shorts right. You have to time it just right. It's much easier to get longs right, and you don't have to time it just right. So in that sense, if you think you're a great trader, then being short Nasdaq is a much more aggressive trade than being long bonds. Being long bonds, it's a positive carry trade. It's a convex trade. And I suspect there's a whole bunch of pension funds that have to have them. But once again, you have to believe that inflation will come down and come down to something below 3%. Otherwise, you're getting a zero real yield. Why are you doing that? So that's for me the conundrum in looking at those trades. And if you do think inflation's coming down, yeah, I think I prefer to do the long end trade to do long bonds. But then I've spent most of my career in bonds, right?
Mm.
I've lost loads of money being short equities over the years. I've lost
You're
very
not
little
alone
being
on
long
that.
bonds. Right.
You're not alone on that. I think we had a lot of people just recently call it a face ripping short squeeze, right? I mean, a lot of you're very right. The short trade has been really tough for people, as we have just seen.
Face ripping. It sounds bad, doesn't it?
It
It
does
doesn't
sounds
sound pleasant.
awful. It's
Yeah.
not every time someone says it, I shudder.
Yeah.
Harry, you emailed me something about the Cheesecake Factory. Was
Yeah.
another one of
So
your indicators? What do you, what
it
happened?
is an
Dare
indicator.
I
So
ask?
me and my wife and my wife's family, we all went off to celebrate multiple birthdays at the Cheesecake Factory. Don't at me, I know, but we're not fancy people. What can I say? So plus we do like a cheesecake. And we're in the line, and we got a table for 10, please. We're told it will be an hour and a half. So we're like, an hour and a half? This is 5 o'clock. How could it possibly be an hour and a half to wait for a table midweek on a Monday for an hour and a half? And the answer that came out is just that's how it is. We look around the restaurant. There's a whole section of the thing that's empty. The
Yeah.
restaurant is half empty. So we come back saying, what about all those tables? Look at them. And they said, we don't have any service for them.
Mm-hmm.
We don't have any service. So there's no point us seating you there because we couldn't serve you. And it didn't make me feel that the labor market is loose, right? The place was humming. There's loads of people waiting for a table. It's an hour and a half, and they don't have service for 25% of the restaurant. That to me strikes me as indicative of something, indicative perhaps that the Fed has more to do.
Yeah. And the same for when they're shoving you out at 9 o'clock because they don't have anyone to stay late or, some ridiculously hour. I mean, I'm getting old myself, and so I'm happy usually to go. I'm on the ARP,
I'm already in bed by 9, Maggie. We're
drink at 3, eat at 5, bed by 8. Thank you. But I'm not gonna move to Florida. Um,
right.
but really things are not the hours you see everywhere, signs that the hours have been amended, and it's not because of COVID anymore, it's because of labor shortages. So
Well,
you're right about that.
it may be both, right? So the labor shortages may reflect something about COVID.
Mhm.
I know it can be obnoxious to talk about. I'm not really interested in pandemics or politics around pandemics. I'm only interested in trading, really, and making money. But what interests me is the idea that a whole bunch of people above the age of 50 have decided, nope, working is not for me.
Yeah.
Good for them, by the way. It may be a sensible decision, but not good for the labor market and not good for a whole bunch of lower margin activities, lower margin businesses. So places like the Cheesecake Factory may be struggling to find labor, and maybe that's why. But
So
I
wh
couldn't tell you.
so Yo-Yo is asking, where do you see interest rates for 2 or 3-year going?
So my first observation about rates is I suspect the market and Mr. Mobius, the market is closer to the truth than Mr. Mobius. We saw that clip, and Mark Mobius, who, by the way, has been around for as long as I can actually remember, he's a legend in EM investing. But I don't think rates are going to 9%. I don't think the Fed believes rates will go to 9%. I don't think they worry about real rates being negative in the first place. And I think they believe that the inflation rate will come down anyway. So there are multiple reasons why rates are not going to 9%, certainly not in one iteration. We will have a cycle before we go back up again. So observation number one, where are rates going? The Fed funds futures are suggesting we peak in March of 2023 at 364. That strikes me as perfectly feasible. The thing that I really disagree with is the notion that they come down 60 basis points by year end. What the guys I know who speak to Fed officials are saying is more likely is this idea of optimistic, opportunistic disinflation. And that's where the Fed hikes rates to where it thinks a longer term neutral is, and then crosses its fingers and hopes something comes up to build a bit of extra slack in the economy, which they can respond to slowly. So I think it's if I wanted to put on a bet on rates going up, I'd probably pay rates at the back end of the ED surface. So it's like 2024, 2023, and say, you know what, it ain't coming down as quick as you think it is. They ain't going to do that. So
you say ED, are you talking euro dollar?
Euro dollars, forgive me. Yes, I'm chock full of jargon. Need to work on that. But yeah, I think that the rate cuts priced in the market do not currently reflect Fed thinking. So the Fed actually has to be wrong for those rate cuts to materialize. And really, they have to be very wrong because they have to see a collapse in the real economy when you still don't have as many workers as you should have. You'd have to see jobs drop away. Yeah, everything's a bit backward looking, but it ain't slowing down fast enough right now. Plus, so I read a piece by Zoltan Poznar. I recommend Zoltan to anyone who can get hold of his work. This isn't really his core skill, which is mostly about the same stuff that Jeff Snyder looks at, which is, short-term liquidity, banks and stuff like that. But he made the point, which I think is intuitively obvious, that actually this is a wartime economy. It's just that we are not directly participating. And in a war situation, you always get inflation. You always get inflation. It's always inflationary. So, every time you watch those videos where you see huge amounts of Russian gasoline, jet fuel blowing up, remember, there's a shortage of jet fuel. There's a shortage of diesel in the world. There's a very expensive relative distillates at this point in time. So I think if, Mr. Putin is in a position to affect our inflation here, and you have to be a little heroic to say, you know what, inflation's peaked and it's coming down significantly. I think it probably has peaked. I don't think it's coming down anywhere near as quick as people who are thinking the Fed's cutting rates think.
Is this a situation where you're mostly in cash? I mean, is there anything that looks attractive here in this environment if that's your base case?
So I see I didn't sell you on the notion of restructured Argentinian government debt.
Actually, I'm holding to the end, but Ralph is thrilled because he often asks about emerging markets, and finally someone can answer that question. Let's get to that. He's saying, what do you like and not like in Latin America?
I like a lot of stuff in Latin America. I'm trying to be picky, and the problem is that trades are all very correlated. So you have to be a little careful. I do like Brazilian equity. I think it's cheap. I think dollar-denominated SOV debt in places like Ecuador, generally speaking, like Argentina, the reason I like that trade is because it's been restructured once. It's hard to restructure twice. And you know what? They restructured it in such a way that the upfront coupons are really low. So why would you default on a debt burden, which is currently low and scheduled to stay low for the next 2 to 3 years? So that's why I made the mistake I made. Right? That's I don't know if now it's cheap enough, but I think generally all of these EM assets are kind of cheap, and it's kind of in line with a comment that Mark Mobius made that you could add to these assets on a 10-year view that they'll perform, and you'll be glad you had them on a 10-year view. That does not mean you'll be glad you had them on a 1-year view.
That's the thing, isn't it, Harry? Because at first, when we heard that, you're like, I viscerally disagree with him. But it turns out that in some respects you don't. And it's that time horizon that makes all the difference.
Yeah.
Long time. That's why he's saying nibble, but you got to have a long time horizon
You know
as
what?
he does.
I
Short
wasn't
term,
even.
he sees a mess still.
Yeah. Look, I wasn't even sure that it is a bear market. I think we are still in the bear market move, but another 150 S&P points, it might, it might not look like a bear market technically anymore. We might have gone over a 200-day moving average. So I'm cautious, right? I don't want to have huge bets here, but I'm definitely, I think we're still intact on a bear market hypothesis. I think what we've seen here is a pain trade that's forcing people out of positions, and it's easy for people like the Wall Street bet guys to ramp these, and in a thin August market. That's my central tendency or core hypothesis. It wouldn't be the first one that was wrong. If that's right, some of those puts that I own may well go in the money. It might not be true, and they may have maybe dust. Who knows? But I would withhold judgment until I see what the Fed delivers and where the Fed's going to be. And my suspicion is there's more pain to come before it gets better. But no, do not own 100% cash. That means you've lost 10% anyway.
Mm.
So if the question is like, are you super bearish enough to own only cash? I'm never bearish enough to own only cash, right? Who could possibly? What do you want me to do with my pension? Right?
Yeah.
I can't just own cash. It's no way to be.
Yeah, and that's why I think so many of us ask these questions because
Right.
everyone is trying to grow that money, right? Harry, it's always so much fun to do the show with you. Thank you so much.
It's my pleasure, and I agree. I have a lot of fun every time too, Maggie. Every time.
Awesome. Thank you so much. Andreas Steno Larson is going to be back tomorrow with Raoul Pal. So get your questions ready and tune in same time. And in the meantime, enjoy your evening. Good luck and take care.